It seems like the wave of unpleasant news coming out of China relating to their tech companies is never ending. Last week, on Friday, we heard Alibaba, the most beaten down Chinese tech name in the market, is planning on investing or giving away, depending on how you look at it, $15 billion towards common prosperity in China. And so we're going to break down in this video exactly what this means for Alibaba shareholders. And then we're also going to look at if this has a fundamental impact on the fair value of Alibaba's stock. And then lastly, if it's time to reconsider your Alibaba or other Chinese tech positions altogether off the back of this latest news. So let's start with the announcement, shall we? As I said earlier, Alibaba announced plans to pour billions of its capital into common prosperity initiatives in China, with the target being $15 billion by 2025. And this obviously comes off the back of Beijing encouraging its firms to share wealth as part of a drive to ease inequality, and obviously with the backdrop of regulatory and operational crackdowns that the Chinese internet companies have been receiving, they felt very much obliged to comply with these requests from the government. We saw Tencent pledge a total of $15 billion towards the same cause, as well as Pinduoduo, another e-commerce company, who agreed to pledge $1.5 billion into agriculture and other rural developments. And obviously the latest company is now Alibaba, with the joint biggest pledge matching that of their arch rival Tencent. And so this begs the question, what does this mean for shareholders of Alibaba, like me, like a lot of you watching? And at the end of the day, $15 billion is no small fee. And this is capital that in theory belongs to the shareholders of the company, so us. And really the billion-dollar question here is this a true donation or an investment? I.e., is it philanthropy with no visible or desired return, or is it some kind of ESG investment that will actually yield some return in the future and benefit the company and please the CCP at the same time? And to get an idea, we should break down what they're actually planning to do with the $15 billion investment, and also what some market experts think. Not the media, but people familiar with the market. So as per this translated Chinese article, they say it is understood that Alibaba's 10 major actions to help common prosperity will be carried out around 5 major directions, namely technology innovation, economic development, high quality employment, care for disadvantaged groups, and then lastly a 20 billion yuan, which is around $3 billion common prosperity development fund, which will target obviously small business in this underdeveloped regions, providing capital for them to grow. And you can actually read through it in more detail if you want to. I will link this article down below, but essentially they're going to be pouring money into technology infrastructure and innovation for less developed regions of China, as well as create programs for jobs and small business creation in those areas too. So it doesn't take a genius to work out that if these programs are a major success, Alibaba would be a direct beneficiary of this. Because if we remind ourselves of the ecosystem that Alibaba has in China, they've got 912 million active customers in China alone. Currently, the remaining 500 million of China's population are probably part of the group they're targeting with these initiatives, as well as, there's a percentage of their current customers of that 912 million who don't have stable or high enough income or constant access to the internet to utilize Alibaba and its services to the full extent. So to put it in context, Alibaba is an everyday consumer goods company, as you probably know, for products ranging from groceries and food to clothing to household items to digital media to internet access and infrastructure. Therefore, they're fueled by and benefit from any economic development in the market that they serve, especially in those regions that have not been heavily exposed to the internet economy yet. That would allow new revenue streams for Alibaba and the other tech firms as well. And as a point of reference, we also have Rui Ma, a Chinese investment or ex-Chinese investment professional, very well informed in the Chinese market, who also states this is not a donation. This is an investment, albeit an ESG investment, therefore with very little visibility on potential returns. And one would imagine it's not like deploying capital into core growth initiatives like we've seen them do before, but it is seen as an investment opportunity by Alibaba, not a pledge or donation or philanthropy for that matter. However, I have to say, although I'm seeing some of the positives of this initiative, at the end of the day, regardless of if Alibaba sees a potential return, you have to ask yourself, would they have staked 15 billion of their capital into these programs without the pressure from Beijing? And for me, the answer is no. So it is a little bit frustrating to see $15 billion of shareholder capital being thrown into these initiatives, probably just to keep the CCP on side. But thinking rationally, and we have to think rationally here, if we review the detail of these initiatives, there is a high chance that Alibaba does reap some kind of rewards from them, and therefore the shareholders of the company should do too. So there is some upside potential in this. It's not like they don't have a lot of cash sitting around. They do. They have around $70 billion of cash on the balance sheet. And if at the end of the day it gets Beijing behind Alibaba again, then probably that is a net positive for us shareholders or holders of the stock. And so if we look at it from a numbers point of view, what does this do to the valuation or fair value of Alibaba stock? Because 15 billion, like I mentioned, is coming out of shareholder pockets over this 4-5 year period. And so as a point of reference, I have my DCF valuation here for Alibaba. You've probably seen it before if you've seen my videos on Alibaba before, but it shows us here, which I've added in, the negative impact of these ESG investments on the free cash flow that we've forecasted up until 2025. And what I've done is obviously hypothetical at this point, but I've taken the 15 billion in pledges and spread it out on a weighted basis over the next sort of 4 to 5 years, and then deducted that from the free cash flow. So we're left with this figure here, which is free cash flow net of ESG or expected ESG investments. And what you see is the underlying free cash flow or theoretical free cash flow actually remaining pretty strong. I mean, we have 2.2 billion in the first year, which is 10% of free cash flow. And then as free cash flow grows larger, we have 3.3 billion, which is around 5% of the expected annual free cash flow. And overall, it still shows a very profitable company, 25 billion scaling up to 64 billion in underlying free cash flow in the next 4 to 5 years. I'd imagine that is exactly the same with Tencent, which is why these companies agreed to these amounts. They look big, obviously $15 billion up front, but when spread over 4 to 5 years, they're less than around 10% of the residual cash that these businesses will throw off. So in terms of the fair value of Alibaba after this news, I have here the net present value of all future cash flows, including the impact after the ESG investments. And really the net present value doesn't move much. We have 238 as the share price or fair value, $238 per share pre-ESG. And then after the ESG investments, we have $236 per share as the fair value. And that's based off a 15% opportunity cost of capital or discount rate, whichever you like to call it, indicating there's still an IRR, equity investment IRR, north of 20%. And remember, this is obviously hypothetical and theoretical at this point. If, for instance, you had 15 billion just spread into the next 2 years, you'd probably see a lower net present value because the first 2 years of free cash flow are worth more to us today than in years 4 and 5, just because of how the discounting works. So it is theoretical. It could change slightly, but what it's showing is that there's not a huge impact on the value of the business today if you subscribe to the fact that the fair value of a business or intrinsic value of a business is the net present value of all the future cash flows that it can throw off. So really, to answer the question, does this affect the fair value of Baba stock? I'd say at $170 per share, a situation like this is already baked in, and maybe even more or something more serious if we reference the current big discount. And so if we move on and answer the final question that we have, is it time to reconsider our Alibaba or other Chinese tech positions? Because at the end of the day, the situation is more complicated than just numbers on a spreadsheet and 5 to 10% of annual free cash flow being put towards ESG. Really, you have to decide if you're willing to put up with what's going on in China at the moment. If we didn't know already, the latest piece of news confirms that Beijing will inevitably be a bit of a drag on some of these big tech companies today and in the future. Of course, governments are always or almost always a drag on free market companies through regulation, but Beijing are a level up in terms of the control and influence they have over their companies. Now, what I will say is, in exchange for this drag, we get a security or business with a lot more upside potential than its comparables in the US or Europe, as a comparable stock to Alibaba or Tencent in the US or Europe would currently be selling at around 35 to 40 times free cash flow quite easily, versus here we have 15 to 20 times free cash flow. So it's a big discount in relativity. And I think, for me, the drag, as well as the fundamental risk and uncertainty, isn't enough to warrant not being involved. But another view you have to take and really think about is if you have the ability to hold through all of the fear, uncertainty, and doubt that will most likely come from holding a Chinese company in your portfolio. And does it fit, your strategy or goals? Is your investing strategy just to limit downside completely, but you're not too fussed about having outsized upside potential? And will you be rational in assessing the risk and what's likely to happen? If not, then you probably shouldn't be involved in these Chinese tech companies, at least at the moment, as you'll end up selling when the stock is at its lowest and buying when everything is fine and it's most likely near its high. So that's something that's individual to you and something, behavioral that only you know yourself as an investor. But hopefully I've laid out what the impact of the most recent announcement will have on Alibaba, what the 15 billion in ESG donations or investment means for shareholders of the company. I'm still holding strong and very much, remain bullish on Alibaba and on some of the other Chinese tech companies that I own, like Tencent and JD, for example. But for anyone who wants to know more about Alibaba and the other stocks that I own, you can check out the Patreon, where I disclose all of my portfolio and all the recent buys and sells that I've made, as well as do exclusive analysis on other stocks that don't make it onto this channel. The current characteristics are smaller early stage compounders, and you'll also get all of my valuation models on various different companies that I've covered on this channel. So I'll leave a link below for anyone interested in joining and supporting the channel through that method. But other than that, I'd appreciate a thumbs up if you enjoyed this video, and let me know your thoughts in the comments down below about all of the topics covered today and the recent news that come out. I will see you all in the next video, and as always, good luck with your investments.